On to your markets news now. Asian stocks were mixed, with Japan, Australia and Taiwan making gains on the day, but Hong Kong and China saw substantial declines as investors nervously await more detail in terms of stimulus for the Chinese economy. The Nikkei share average rose by 0.77%. The Hang Seng Index declined by 3.67%, while the Shanghai Composite Index fell by 2.5%. US markets continued on their winning streak yesterday, with all three major gauges ending the session in positive territory. This was driven by high expectations around the third quarter earnings season. Tech firms performed particularly well on the day, with the likes of Apple up over 1% and Nvidia up 2.4%. Meanwhile, the US dollar continued to strengthen as market players anticipate that the Fed may not cut rates as aggressively as previously thought. The Dow Jones Industrial Average closed up nearly 0.5%. The S&P 500 gained 0.77%, while the Nasdaq Composite rose by 0.87%. The rand is trading at 17.61 against the US dollar, 23.04 vis-a-vis the British pound, and 19.20 against the euro. The JSE is trading weaker today, with the All-Share Index falling 1% to 85,655 index points. Looking at commodities, gold is trading at $2,653 and platinum at $982 per ounce, while the price of Brent crude oil is trading at $73.76 a barrel. Well, to unpack the markets for us, I'm joined by Martin Smith. He's a portfolio manager at Anchor Capital. Thank you very much, Martin, for joining us. So what's driving the markets, and why is there a feeling that the Fed won't be as aggressive in cutting rates as previously thought?
So I think what you've seen from global markets is, or specifically out of the US, is just continues to grind higher from here. And I think it's on the back of a better economic backdrop. And I think the market likes that. But I think there's also still a little bit of cautiousness around. You've got an upcoming election. You've obviously got macro data coming out kind of every week around inflation and interest rates and growth. And then you've obviously also got the geopolitics that's also still kind of up in the air. So the market is grinding higher, but still a little bit cautious. Insofar as what the Fed are going to do, it seemed like there was maybe a chance for 50 basis points cuts about a week and a half ago, but then we saw the jobs numbers that have kind of pushed that down to 25 basis points being the number that's probably going to come through, if any. There's about a 90% chance, or the market's pricing about a 90% chance of a 25 basis points cut now in November, and the 50 basis points cut is no longer there.
Yeah. So what's your take on the local currency, how that's performing? We know that the US dollar is a bit stronger, so that would have an effect on emerging market currencies like the rand and also our local stock market.
You're 100% right there. It's the stronger dollar that's driving the kind of exchange rate at the moment. And on the back of what I just mentioned now, with the Fed more likely than not doing 25 basis points as opposed to 0.5%, it shows up in the stronger dollar, which obviously kind of impacts our rand dollar exchange rates, even though things are looking a lot better and more positive from the South African risk appetite perspective. Insofar as our local markets, we've obviously done very well in the last few months, but we've seen a little bit of an unwind of the Chinese trade that we've seen in the last couple of weeks start to play out a bit of profit taking. So that obviously affects things like our resource stocks and Naspers and Process. And so we've seen a little bit of weakness in those shares, and that's obviously filtering through into the kind of overall JSE index.
So the IMF has warned that total public debt is set to exceed $100 trillion this year for the first time, seeing global debt reaching 93% of global GDP, ultimately hitting 100% by 2030. I mean, these are crazy numbers, and it seems they're being driven largely by the United States and China. But from a market's perspective, what are the possible implications of this?
You're 100% right. It's the Chinese story and the US story, and the US is higher than it kind of historically has been. And I think if we look at these numbers, it's much higher than average, and it's increasing. But I think if you look at what the market's seeing, it's that for now it seems sustainable. It obviously can't continue at this rate, because then there will be long-term implications, but it is quite a long way away. For now, it seems sustainable, but again, it needs to be curbed kind of in the years that continue from here. So for now, the market's not overly concerned, but definitely something to kind of keep an eye on the horizon.
Yeah. So Looking at a company stock, apart from the market fundamentals, which have currently been poor, how concerned are you about Sibanye-Stillwater being compelled to pay damages of 21 billion rand for reneging on a Brazilian nickel and copper mine deal? How badly will this affect them? This was a decision, of course, that was taken at a London High Court earlier.
So, I mean, if you look at where PGMs are at the moment, Sibanye is kind of burning through cash at these levels. So obviously not great for them at this kind of current point in the cycle. If they do have to, then obviously it's going to put them in a bit of a tricky position, but we'll obviously need to assess that when it kind of comes through and the numbers come through. But again, yeah, need to keep an eye on it. But again, at these PGM prices, it is definitely a bit of a concern for them.
All right, we're going to leave it there, Martin. Thank you so much for your time and insights. As always, Martin Smith, he's a portfolio manager at Anchor Capital. The Organization of the Petroleum Exporting Countries, also known as OPEC, says it's lowered its predictions for global oil demand growth for this year and next year. This is the third month in a row that OPEC has made these downward adjustments. In its October oil market report, it estimated that global oil demand will grow by 1.93 million barrels per day in 2024. This is a decrease from the 2.3 million barrels per day growth predicted last month. Even with the third consecutive downgrade, OPEC has stated that this year's global oil demand growth is still well above the historical average seen before the pandemic. The organization has reduced its estimate for global oil demand growth in 2025 to 1.64 million barrels per day, down from a previous estimate. OPEC lowered its forecast for global oil demand growth in 2024 and 2025 in its monthly reports for August and September. Until August, OPEC had kept its predictions of 2.25 million barrels per day for this year and 1.85 million barrels per day for next year, which were first made in July last year. Last month, 8 OPEC plus countries extended their voluntary oil production cuts until November and will begin to gradually reduce these cuts from December.